This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
To another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome on Kevin DeMeritt with Lear Capital. We're going to be diving into really some interesting stuff as it relates to precious metals and investing with retirement plans, personally and the like. Precious metals, while they do serve a purpose of being shiny and nice, they also are a definite route that people can go for hedging against things like inflation, economic uncertainties, and a lot of other things. And we're very pleased to welcome on Kevin today. So Kevin, if you wouldn't mind, give us a little bit of background about yourself, what your firm does, and then we'll kind of branch right into the topic at hand.
Sure. Yeah. So Lear Capital specializes in precious metals. We've been doing this since 1997 with over 90,000 customers. We've done over $3 billion worth of business. And about 50% of that is in IRAs. So I look forward to going over why precious metals for a portion of your portfolio and how best to use it in an IRA.
Oh, fantastic. So let's kind of at least set the general standard of when people are talking about precious metals, what exactly are we referring to? Because, people buy and sell metals. We even had a gentleman on here talking about rare earth elements and metals, and, you can certainly, scrap copper and aluminum, but we're not talking about things that just maybe have intrinsic value. When we're talking about precious metals, what exactly are we talking about in this investment space?
Yeah, for us, that would be gold, silver, platinum, and palladium. Most of the business is going to be on gold and silver. So the other metals are more industrial. So we tend to use those as just a hedging for a portion of your metals portfolio. Okay,
sounds great. Now, why exactly, at least in the general context, are gold and silver kind of the primary focuses of what people are doing? So you mentioned platinum and palladium as, again, other alternatives, but why do, at least people, that are interested in investing and maybe specifically your company really kind of focus on those two specifically?
Yeah, I think most people are looking for a hedge against volatility, a hedge against inflation or uncertainty from a political aspect or war, 9/11, just these unexpected things that happen. But shockingly enough, Alex, a lot of people are starting to come to realize that, gold is a great investment hedge to get some returns. So since the year 2000, most people are shocked to know that gold has outperformed the stock market for all of these years. So we're starting to get more and more people in just for an investment side of it, as opposed to the hedging and against inflation.
Great. So in your own words, maybe let's kind of, hear kind of, from you, someone that sells precious metals, someone that sees the people, day in and day out that are interested in this asset class. What are some of the kind of main driving factors that push people into, you mentioned inflation and uncertainty, but maybe let's give some examples on, kind of how this fleshes itself out in the actual investment process, between like what historically has, pushed people into this, again, why this being a good idea and, why do these things intrinsically have value?
Yeah, great question. Most people, they are looking for a hedge against the inflation, money printing, so on and so forth. So when I started in 1997, my investment thesis was the governments around the world will probably continue to print money at a faster and faster pace. We've seen it throughout history, and it's coming to be true. So if that's the case, then how do precious metals help? So to give people an idea of how predictable precious metals are against government money printing, if we go back to 2007 with the Great Recession, we had about $9 trillion worth of debt. Today, we have $33 trillion worth of debt. So let's round out and say that debt is up almost 300%. The price of gold at the time was $650 an ounce. We're at $1,940 an ounce today. Again, we can round it up and say, look, it's around 300%. Well, debt has been increasing 12 to 15%, and the precious metal has increased by 12 to 15%. If you believe the government's going to stop printing money, then you probably don't want to own gold. But if you believe they're going to continue to print money around the world, then gold's a good alternative, because every time they print those dollars, your paper money becomes worth less, and tangible assets like real estate, precious metals, other intangibles are going to increase in value. So
Yeah.
That investment thesis should hold up for long after we get done with this interview in 10, 20 years from now, because I don't think the government's going to stop printing any money.
Yeah, you can look back and, again, kind of one of those certainties is that, the increase of the, printing of money. I don't think we've really seen a retraction in that, at least, in my humble 34 years on the planet. I can't recall that actually happening, but basically it's kind of an interesting, play here is that you're really kind of, playing into inflation because, as the government continues to increase money, prices of assets tend to increase, the inflationary aspect. So really, you're kind of investing into inflation, something that is, predictably kind of gone up, it peaks and valleys, but it is kind of up and to the right. If you look back 30, 40 years, inflation has gone up pretty predictably. So it's kind of interesting that this asset class would almost be playing into inflation to your benefit. Would that be kind of a fair assessment?
Well, yeah, absolutely. And how much better of a return do you get with tangibles as opposed to just trying to keep up with the rate of inflation? So not only do we want to keep up with the rate of inflation, but when you sell, you obviously have to pay taxes, unless, of course, you're in a IRA. So how do we keep ahead of a rate of inflation with the tax ramifications in there? So precious metals would have to increase faster than the rate of inflation. That's exactly what happened. We have the rate of inflation around 3.7%. It was as high as 9, but on average, it's been around 2.7 to 3.5%, let's call it. And precious metals have performed at 8 to somewhere around 8 to 12%. So after tax, even, it's been a great investment to make sure that the purchasing power of your dollar is going to be intact and hedge against the volatility that the government causes by massive money printing, like we saw in 2008, or some of the other corrections like we saw with the dot-com crash.
Sure, absolutely. Now let's kind of maybe dig into a little bit of the underlying, different assets. Because when you say gold, all gold is not created equal. Your little 10-carat ring is not exactly what we're talking about. And there are certainly, and I would be curious to know, from your point of view, for those of you out there, any major government organization, the big ones take, the United States, Australia, Canada, Mexico, China, all mint, if you will, precious metal bullion coins. Now, speaking to market volatilities and everything else like that, is there a particular market for different countries? Again, this is, they are printing currency to a point. The gold American Eagle is what, technically $100 coin. If you want to sell me one for $100, I'll take it. But, is there any kind of, tied to, kind of who produces these things? Or let's kind of get into the market actually of what people can look at, when it comes to actually investing in these types of assets.
Yeah, so most of your American Eagles, Maple Leafs, things like that, they're minted by a government mint, and they trade basically with whatever the spot price of gold is trading at. So they don't work like a rare coin that was minted 90 years ago and it has other value, a collector premium or a scarcity premium attached to it. They're just going to go up and down with the price of gold. So gold bars, 1-ounce coins, so on and so forth. What I will say is that a lot of people want the 1-ounce bars because they believe they're getting closer to the spot price, which is untrue now. There are less 1-ounce bars being minted than there are 1-ounce coins. And the coins actually give you a lot of security from counterfeiting. So one that a lot of people are interested in when I say it is the reeds on the outside of a quarter or the outside of a gold coin are not there so you can hold the coin. They are there because in the old days, Roman coins, so on and so forth, people would shave off a little bit of the coin on the edge. And so you could tell if those reeds were on there, if they were gone, somebody shaved the coin down a little bit. So there's a lot of safety features in the coins that the bars don't have. And then if you go from, your bullion coins, you move up to your rare coins where they don't mint them anymore. They were used as money, $20 St. Gaudens, $20 Liberties, things like that. And they move up and down independently of the spot gold price. So when investors are looking for maybe longer term type of situations, maybe the rare coins help with a portion of the portfolio on top of bullion at the same time. And you want to diversify with both categories of metal.
Yeah, absolutely. And just to the point, again, I always try to, steer this in the middle of getting people interested, but specifically, if you are interested in doing IRA investing, you have to trade, you have to acquire coins that are traded on their bullion content value. Granted, part of your portfolio could certainly be in, things that have collectible value and of that nature. But as far as retirement plan investing goes, just make sure you're kind of, looking at those buckets if you're interested in precious metals. Now, you know, government issued coins being what they are, granted, you have the security of one, counterfeit protection, but also knowing what you're buying. Because one thing that I've explained to people, at least in my capacity professionally over the past decade, is that not all gold coins, even if they're minted by a government, are exactly the same. The one I like to pick on is the South African Cougarand, which was a great marketing effort by the South American government to sell their precious metals and get it in the market. But they are not as high of a grade, meaning the gold is not as pure as a gold American Eagle. Maybe that's kind of what I'm getting at, is getting into understanding what people are buying and things to watch out for in the market.
Yeah, so your Krugerrand example, the Krugerrand has an additional copper in it, and that makes the coin a little bit more durable. However, when you weigh the coin, it weighs more than an ounce. So there is 1 ounce of gold in there. It's just the durability of the copper takes away from it. So you couldn't put that coin into an IRA, where you could put a maple leaf at 4 nines into an IRA. So the 4 nines is the finest. It's 0.9999 pure. And so you can put it into your IRAs. An American Eagle is an exception. It actually does have copper in it. It is not 4 nines gold pure. But the United States government allowed that one exception into IRAs because obviously it's a US government minted coin. But that copper is just for durability. More than the quality of the coin.
Yeah, absolutely. And that's, again, a good distinction for people to understand, is that just because something, the actual metal might not be as pure, if you're buying it based on not necessarily the weight of the total coin, but the weight of the precious metals, that's definitely something to consider. Because a 1 ounce gold maple leaf might weigh less than a Cougarand, but you might be getting the same exact amount of gold, is kind of what you're saying, correct?
Correct. That is 100% correct.
All right, fantastic. So, past that, again, kind of an easy example that I pick on just because you can't own a Cougarand and an IRA and they, are popular. They were marketed well by the South Africans. But what are some things that people, need to watch out for? Because, a lot of this industry is based on good faith. And, when you're buying something that's the size of a coin, there has to be a lot of faith and trust in there. So how can people that are interested in this go about protecting themselves throughout this process?
Well, one, I think the metals that go into an IRA, people have to understand it's not only checked usually by the dealer, but it's going to be checked typically also by the depository. So the depository is going to look at the coins and bars and make sure that they are what they say they are. If that's the case, then you're looking at different companies and the pricing that you're going to be able to place the precious metals into the IRA. And I think that's probably where people really need to pay the most attention to is, what is the price I'm paying either for an ounce of gold, or if it's got some scarcity to it, because there's coins you still can place in IRAs that have some scarcity to it, what is my fee? And for us, we have an account agreement. The account agreement has our range of prices. Then on a recorded confirmation line, we're going to tell you exactly what you're paying. And then your invoice should come immediately after with that exact fee on your invoice. And we take it one step further, Alex. We actually give people a 24-hour risk-free purchase guarantee. So when you receive your invoice with the spread or with the fee on it, you have 24 hours to cancel if you don't like what it is. So to me, it's people understanding what they're paying for that metal and why is going to be extremely important for investors to make sure that they get the value that they're looking for.
Yeah. So what people need to understand in this concept is that you have, granted, again, what the ounce of gold is like 1,900 and change, like about $2,000 an ounce right now.
Correct.
So that 1 ounce American Eagle, yes, you might, let's say you put 4 of them, to invest with someone particular, again, Lear Capital, anyone, you might see, again, there's, okay, $8,000 worth of gold, but that's not what you're paying for. Obviously, you'll have to keep the lights on and pay for the internet connection. So, there's a service that's being provided there. So when people typically look at this, what are a few things they might see on their invoice? So there's going to be a bid price, there's an ask price, there's a spread. Maybe break down some of those terms so people, when they're doing this, they're not kind of, hit out of left field saying, oh, I thought this was one thing. What can people expect when going through the purchase process of investing in precious metals?
Well, when you're going through the purchase process, there are some companies that don't even tell you what you're getting in the IRA before they deliver it, which is just absolutely nuts to me, but it happens. So make sure you understand exactly the metals that you're getting. You should receive an invoice with the pricing on the invoice. And the pricing on the invoice, if you had multiple metals, sometimes doesn't show the bid or what somebody paid, but it'll show you the fee that you're paying. It should be clear, just like, buying anything else. If your stockbroker told you, hey, my fee is 1%, then, just deduct 1% from what you're paying. That fee should be on the invoice so that the person knows this is what my buyback is if I took that fee out of it. If the fee is not on the invoice, I would tell everybody, ask the company to email me exactly what the fee was so that you know and have it in writing. There's a lot of differences in pricing from companies, and it's one of the reasons that we put it on the invoice and then give you 24 hours to call around. We'll compete. We are not the least expensive, but hopefully we gave you enough value and recommendations that you still go with us. But if you don't, you found it, so much cheaper than us, then by all means, make sure that you get the best value for your money.
No, absolutely. And those are good points, because a lot of people, kind of have, the idea of, they're so used to buying, things and just being like, this is the price. Okay, add tax. That's what I'm buying. It's just, when it comes to investing, especially in alternatives, or if someone doesn't have exposure to this, understanding where, sometimes people get sticker shock, but again, you can't just go and buy these things at your local grocery store. There's a reason that there's a dealer network, and just understanding, again, getting into things, you pay a commission on buying real estate. There's people in here that are trying to be professional and assist with this. So, they got to get paid too. So now that we kind of understand the purchase side of things, again, painting with a very broad brush, let's maybe dig into, silver versus gold and why someone might want to invest in one versus the other. And then we can also maybe touch on the other two of platinum and palladium. But again, there's probably, besides just the price point, granted, silver is significantly cheaper than gold. Why would someone want to go with one versus the other? And then maybe get into, kind of, again, the holistic approach of, looking at it 30,000 foot view of maybe why mixing the two might be good. So I'll let you kind of lead off from there.
Sure. To us right now, the silver market's just absolutely on sale. So I think of silver as this double play investment right now, especially if you believe that there potentially could be a recession coming. So on one side of the equation, we've got this enormous amount of demand coming from the solar panel part of the market. So without silver, there is no solar, right? They use silver paste. You cannot recycle it. It's just very difficult, and it costs too much money to recycle that. So all of that silver is gone. We're not talking 1,000 ounces here. We're talking millions of ounces per year that are placed into solar panels. The new solar panels coming out are 20 to 50% more efficient, but they had to use 20 and 30% more silver just to get there. So silver demand from the solar panel industry is absolutely going through the roof. From medicine, from batteries, all of the things we need in life, even water treatment plants now using silver. So that silver is basically gone. If you look at the demand right now on the silver side that cannot be replaced, it is absolutely tremendous. In the next 15 to 20 years, most of the silver supply will be gone. When I say silver supply, I mean coming out of the ground each and every year, we will eat through that, and there will be no surplus. So long term, silver should do well if the economy does well, and solar and batteries and everything else are under demand. We already know that silver can go up to $49 an ounce in a recession. We saw it in 2008. So if we get another recession or another pullback in the stock market, then silver should be much higher than where we are today at around $23 an ounce. So I like to look at it as this double play kind of investment. I'm going to do very well if the economy does extremely poorly, and I should do fairly well if we just continue with the demand that we see on silver in today's market.
Yeah, so what you're saying with silver is that it kind of has a twofold aspect, because it is a very utilized metal with regards to industrial application. And correct me if I'm wrong, but isn't silver the best known conductor of electricity that we have, besides superconductors and really like bespoke stuff? Like, just out of the ground, silver is kind of the benchmark for electrical conductivity.
For its price, yes. There are better metals, but they cost so much money you couldn't use them. So silver for all intents and purposes. But On the solar side, nobody's been able to figure out how to make silver that's not in the ground, right? We're not chemically making it or what have you, and they need it. And you're just going through an enormous amount of it. And, nobody believes the green agreement or the green movement is going to end anytime soon. So if you believe they're going to continue to make solar panels around the world and try to get this climate change under control, then you should do fairly well with silver regardless of what happens.
Yeah, absolutely. And I think at least from a standpoint of, again, a long history of utilization with regards to, again, consumer products, electronics, and kind of the thing. That's one thing I really personally like about silver is one, the price point is nice, but two, you kind of have built-in security in two different aspects of the investing trajectory. Granted, the price markers go up significantly lower with that, but you can also buy a lot more in volume. So, you get exposure to both of that. It's funny that it's just odd that, something as simple as silver can be so utilized. I was just looking at some speaker cables for my new stereo and looking at the pricing of ones that are pure silver is eye-watering to say the least. I wanted like $700 for a 3-meter cable. I was like, copper will do just fine.
Yeah.
So getting back to that, again, we have the twofold play with silver. Let's kind of get into, what gold is utilized for, because it definitely has high-tech applications as well, but maybe what are kind of the investment theses that a lot of people use for gold investing?
Well, I think the big investment thesis is, again, money printing around the world. Today, or actually Friday, they came out with the world debt, which was $330 trillion. This absolute unbelievably eye-watering, amount of debt around the world, and
That's
33 trillion. Yeah, $33 trillion for the first time here in the United States. Janet Yellen just came out today, actually, on Yahoo Finance, says Americans should anticipate a decline in the U.S. dollar as the world reserve currency. So what's happening there, Alex, is the world central banks last year had purchased a record amount of gold not seen for 50 years. So the last time they purchased the amount of gold they did last year was all the way back at the beginning of the 70s when we had inflation. Well, central banks are not day traders. They're not hedge funds. They typically buy and hold for 10, 15, 20 years at a time. And if I could have a money printing machine in my garage and print up a bunch of paper money and run out and buy physical gold, I would do it. And that's exactly what they're doing because they know the currency's going down in value. Well, in this report, it says the first quarter of this year, central banks added 228 tons of gold to their reserves, which is a new quarterly record. So even though last year was a record, this year they're even purchasing more. So the investment thesis, I think, is the same. Most people have heard about BRICS, the currency that's trying to overtake the US dollar as a world reserve currency. Initially, people wanted to back some portion of that by gold. If that happens, the gold price probably skyrockets because it's hard to back a currency even with a little tiny piece of gold or a portion of gold without having an enormous demand part of the equation to deal with. So it's the same old thing over and over and over again. You print money and tangible assets, doesn't matter if it's gold, real estate, or other tangibles, should move up in value, but gold's been used as money for over 5,000 years. So that's where the central banks are heading to hedge themselves. And the last time they purchased in the 70s, gold was about $50 to $75 an ounce as they were purchasing, and it hit $850 an ounce. So we're at $1,900 today. So it was a pretty good bet.
Yeah, so from that perspective, I know that, and correct me if I'm wrong, are there any still currencies that are still backed by precious metals, or do they all, remove themselves for being specie-backed currencies?
Well, they all remove themselves for the one reason, so they can print money, because if you had to print money and back some of it by gold, it makes money printing harder, right? So we got off in 1974, and the value of the dollars collapsed 97% against gold. So the only currency right now that supposedly is backed some small portion by gold is the Russian ruble. So when we sanctioned them, then the ruble was crashing, and they said, we're going to back some portion of it. So you look at China, Russia, Brazil, all part of the BRICS currencies. You look at the central banks that are purchasing the most gold. It's all of those similar central banks. So that I don't know what the percentage is that they've backed, but it did help the ruble and strengthened it up.
Sure. So, and I guess kind of, that was a little bit of a tangent question, but what I find interesting about that is that if we don't have a specific currency that is backed by precious metals, then what is kind of, what's the reason, them for a central bank to buy a lot of precious metals, in this case, gold, if they're not going to back it? Is it just an additional asset they have to use to, float whatever they have going on? Like, I think of a bank, acquiring assets, like lending money out, doing X, Y, and Z. But again, I'm not super well versed on the kind of the central banking concepts and theories behind why they do what they do. I'm again more the retail, the investment side. So, if a bank goes out and acquires a large chunk of precious metals, why are they necessarily doing that? If they're not necessarily backing the currency, again, if you back the currency with gold to print more, you have to have more gold in reserve. But if they're not doing that per se, or if they're doing it a part of it, just maybe speak to that a little bit because I really don't know. I'm curious to know.
Yeah, that's a great question. So the United States, as of now, has the biggest world's reserve at the central bank. Okay, so even though you're not backing your currency by gold, people are still calculating your currency and calculating your reserves. So China is trying to catch up to the United States because they would love to have the yuan as the world's reserve currency. And there's got to be some sort of backing. It's either a very stable economy, it's backed by gold. So that would be one reason. The second reason would be if you're printing up an enormous amount of money, as the United States is, and other countries are holding US dollars, why would they want to hold the US Treasury when you're printing up that kind of money? They swap out the treasuries and they purchase gold. So the value of the dollar falls, the value of gold goes back up. They can take the gold at some point, 10, 15 years down the line, and then transfer it back into dollars at many more dollars than where they took their currency to swap out. So if you're holding U.S. Treasuries at 3.5% and inflation's 3.7%, was 9%, what country wants to hold that?
Mm-hmm.
Nobody wants to hold that.
Yeah, exactly. And that's kind of the underlying, issues that happened with the savings and loan crisis. You had rampant inflation and then, debt being issued out that was being outstripped by inflation. So, it's definitely kind of a model that is, historically you can look back on and see how those things can be problematic, especially, I mean, we saw it earlier this year with Silicon Valley Bank. They have all this money lent out and then, inflation goes up, the federal funds rate outstrips what they can lend out for, and then they can't cover deposits. So, to kind of bring that back full circle, the acquisition of this is just they're seeing the acquisition of precious metals as a better bet than debt of a foreign nation. Is that kind of in general what they're looking at?
Well, 100%. But to use your bank example, I'll give you some sort of indication. Let's say you bought a 30-year treasury and you bought it at 3.5 and inflation goes to 7%. The interest on that note then goes to 5.5 or 6%. That is not, if you put $100,000 in it, it's not $100,000 because you're getting the net present value of that bond back, and it only is paying 3.5, but somebody's needs 7. So you need to lower the value, the face value of that note to give the next person 7. So for those banks, really what happened is they couldn't sell those treasuries because they were underwater, right? So they didn't have enough of them. They weren't capitalized the correct way at that point. Well, for a foreign country, it doesn't work that way. They can print money. But who would want to hold a bond that's going down in value? Hey, I put $1 billion into this thing, interest rates went up, inflation went up, and the value of this bond is now $80,000. I lost 20,000, or to them, $20 billion. They don't want to do that, right? And they don't want to hold it to maturity because then you're just going broke slowly. By the time it does mature, it's worth so much less in the current dollars 20 years, in the future. Mm-hmm. So nobody wants to do that. A country doesn't want to go broke slowly. They would rather hold something that's keeping up with the rate of inflation, and gold's done a tremendous job. It's up the same amount that the US government has been printing money as a percentage per year basis.
So conceptually, if these governments are buying gold, obviously that's going to have the consumer effect of driving up the cost of, there's additional demand and large demand for this precious metal. So again, that's going to drive costs up. People bought it, buy low, sell high, that general thesis kind of works out. But again, to that point, if you have, you can hoard all you want, but at some point this is going to, influx back into the economy, I'd imagine. Or is this, when governments buy gold, is it just intra-government trading, kind of like bonds and the like? Is it just going to be the additional demand is going to drive up price? What I'm concerned with, at least in that front, is that if you have them continually buying, at some point they're going to need to liquidate. Or is it just, do governments ever typically liquidate their precious metal holdings and put it back out into the general retail world, or is it again just kind of the Scrooge McDuck? They just continue to fill those coffers up.
Yeah, they have sold. But I'll give you the ideas of the time frames. Typically, they'll hold 15, 20 years or longer. So when you look at central bank purchasing, that's going to be a really great indication that maybe gold would be a decent investment, especially when the purchasing is continuing, as I said before. But if they purchased in the 70s, they started selling in the 1995 to 2000. So really the last people to kind of sell was the British government, and they sold off gold at $275 an ounce. Absolutely the wrong time to sell, because gold immediately went to like 475 and 5.25. But they do hold for extremely long periods of time. So this purchasing we see today for the next 10 to 15 years should be held in storage where that metal's gone. We're not going to see it come back on the market. But every investment's that way. Hey, look, if I see a big institution selling off stock, I probably need to get out of it if it looks like enough of them are selling. Central banks are a little bit easier, right? They move so much slower than some sort of institution that usually the buying and selling that takes place, you're fairly well ahead of, and can move your metals into something else, into the stock market, wherever you want to place it. We have pretty good indications when they're buying and when they're selling.
Yeah, and to the point, just to make sure I'm clear. So when they liquidate, it's not just intra-government. They put that back out into, they say, hey, we're selling, and I'm assuming there's some type of, dealer consumption network. But that would actually, them, selling, it's not just like the British government or the US government selling to, Australia. It's going back out into the general populace of the available gold supply, correct?
It's going out to the available gold supply, and they do have intercountry swaps with the gold. So a lot of countries, a lot less now because they wanted their gold in their own country, but a lot of the country's metals were stored at Fort Knox. So if one country wanted to buy and one country wanted to sell, they would just swap back and forth within Fort Knox. If there was something left over, then that would be sold on the open market.
Okay, good. Now, what have we seen as far as like the general market fluctuations? Like when Great Britain went and sold in the early aughts, what kind of price do we see on the general market when that happens? Again, you're saying 15-year kind of trailing lag for when that happens, but what kind of effect does that have on the market in general? Is it a big drop in price because there's more availability, or is it I guess I'm getting at is it predictable, or is it kind of just depends on how much is pushed back into the market?
Usually what they do is they're going to give you a fairly advanced warning on when they are going to sell. So when the British started selling, we knew a year and a half in advance, and they mapped out how they were going to sell. So it could be, we're going to sell 200 metric tons per quarter for the next 3 years. That's typically how they do it so that the market can look at it and figure out how to absorb it and what the price should be based on that. So
Okay.
central banks don't want to, mess up other central banks either. So they don't want to just dump a bunch of gold on the market and then have everybody else's gold go down, because that's just going to tick off all the other central banks, right?
Mm-hmm.
Most of these central banks are not holding it just for investment purposes. They're holding it like Russia to say, look, if I was sanctioned, if something happens with my currency, what have you, at least I have something to back that currency and give people stability. No different than what happened in the United States. In 1933, the US government confiscated gold, and then they took that gold and they paid countries for the war. The countries that we were paying didn't want our paper dollar, so they used the gold to pay off that debt. And so there's a variety of reasons why countries want to hold some of the gold, and they don't typically want to sell huge amounts of their holdings. So they might sell off, 5%, 10% of their holdings. Typically, it's not all of them. They don't wake up one day and say, hey, I'm getting rid of gold altogether.
Yeah, and they wouldn't want to do that too because, by virtue of trade, you don't want to tank someone else's, tank someone else's purchasing power and exchange rate of their currency if that's kind of what they're playing at. Because then how are they gonna buy anything if the purchasing power tanks of their currency? So I definitely kind of see what you're going at there.
Yeah, and the other thing is if they woke up one day and said, look, we're going to sell all gold in the central bank, they probably couldn't. So whatever they couldn't sell, they would drive the price down on. That's why they give such advanced warning. They want the market to understand and be a normal traded market so that they get the best value for their holdings as well.
Yeah, so I think this kind of brings us into kind of a nice way to, kind of bring this in for a landing is that, we've discussed, the the reasoning behind what metals people might want to buy, the reason, why these can be viable investments and what kind of affects pricing and the, the markets for each of them. But what's some typical investment strategies that people use? It's easy enough to say, okay, I bought something that has value. Obviously, you want to buy assets that have value, but what's kind of the end game for a lot of people that do this? Is it just simply a long-term buy and hold to hedge against that, and kind of the rainy day portion of your portfolio? Do people look at this as saying, hey, do you look at reposition events to try to get arbitrage between pricing? What's a general thesis for a lot of people, or is it as varied as anyone else investing? It just depends on what they're trying to accomplish.
It really does. Like, you said you were 34, 35 years old, right? You and a 55-year-old like myself or a 7-year-old are going to have completely different ideas about what they would like to do with the metals. But what I would say for most people is it is a long-term investment. As far as a rainy day investment, 15, 20 years ago when I started, it was more of a rainy day investment. And because of government money printing, which I think is going to continue, it's more of a rainy day type of an investment. And also, can I make some money with this thing with either, gold or silver? So if you had a $100,000 portfolio, for instance, in 2000 in stocks in the Dow, that portfolio today would be worth $325,000. If you diversified 20% in gold and 80% in stocks, today that same portfolio would be worth $385,000. You pocketed an extra $65,000. I use that because it's fairly long term, and you should think long term with precious metals, in my opinion. So yes, people want it for a rainy day because they understand what happened in 2008. Gold skyrocketed, silver skyrocketed. Over longer terms, if the government's going to continue to print money, then you should be able to get, just mapping the return out there, 8 to 12% on your money in a precious metals appreciation before fees on the metal.
Yeah, certainly. It definitely kind of makes sense for that. So basically, treating it as, and I would say also maybe a factor into that is also the fact that precious metal pricing does not move as fast as other things. Granted, it's moving quicker in today's economy with how much money's being printed, debt ceilings, things like that. But you're probably not going to see price fluctuations like you would rampantly on a stock market. So again, it's also kind of a hedge against volatility in pricing, if you will. Because granted, just like any investment, it can go down. I think historically, your gold is not going to be worth nothing. It could certainly be worth less than what you bought it for. But again, looking at historical averages, it has tended to go up over time. Look at it, pick it out, math adds up. But is that also kind of maybe a benefit to this as well, is that the velocity of pricing is not nearly as volatile as, buying individual securities?
Yeah, most of the big appreciation in metals usually comes because of hyperinflation like we saw back in the 70s, or comes because other asset classes are extremely volatile. So if you look at 2007, gold was $650 an ounce. It ran up to $1,900 an ounce fairly quickly and offset some of the loss that people had in either real estate or the stock market. So you will get these incredible advances, but typically that's not what I hope for, because that means something's going wrong in the economy.
Yeah.
And people are hurting in different areas. We just like a nice, steady appreciation, and if something bad happens, you have your rainy day. But how do we get a reasonable return out of this investment? By just buying and holding.
Yeah, and to use the roller coaster analogy, what goes up is going to come down on the other side of this thing. So if you have this great ramp up, well, there's going to be some type of correction and, price fall off on the backside. So, again, I think with a lot of people, maybe options traders are kind of the black sheep of that, but understanding that, this is, again, longer term, targeting that, that solid long term amortization of this thing is where you're kind of going with this. And again, there's definitely some benefits in the fact that you have an asset that is tangible. At the end of the day, things like real estate, precious metals, things you can reach out and touch are great. You can invest in securities, and granted, there have been companies that have been around for hundreds of years. But look back at 2007. We had, Lehman Brothers had been a company that was in business 120 years. Overnight, they went away. You could have, been looking saying, hey, oil and gas and energy are doing great, but you have Enron, and what happened to Enron, WorldCom, all these kind of things, they can cease to exist. I mean, Enron was trading at like $200 a share at one point, and it went to absolutely zero. So, the benefit of investing in this stuff that, again, you can't ever speak in definitive things, but, if the Romans were utilizing gold and trade and everything, the likelihood that it's going to be worth nothing is very slim, bordering on statistically insignificant, I would say.
Yeah, and I think the advantage to this type of tangible asset that a lot of other tangible assets do not have is just the liquidity factor. It doesn't matter. I can take an ounce of gold and go anywhere in the world, and the spot price of gold is going to be the same anywhere I go. When you're talking about diamonds and real estate and things like that, there could be liquidity issues that gold does not have. So it's not just the tangible part of the investment, it's also the liquidity part where you can call up and sell it with a click of a button and make sure that you're going to get that value that day.
Yeah, that utility, I think, is something that I really appreciate about this is that, you can take, a gold coin, if it's a real gold coin, and I could go to Canada and I could find someone to exchange, goods and services for my gold. I could go to Australia, I could go to India, basically anywhere that has some type of developed economy and it's not just, an agrarian tribe somewhere. And, you can utilize this for, goods and services, for trade. You can run an economy on this, and you don't have to necessarily, again, government's not printing money. It's a tangible piece of, valuable asset. We're kind of coming up on towards the end of it here. So I'd like to always kind of turn it over to my guest. If there's anything that we missed or that you would like to bring up, please do. And then also, how can people, get in touch with you? Where can they find Lear Capital as well?
Yeah, this podcast, it's all about education, and that's really what we're about. So, your podcast is great, educating people, trying to help people understand investing and the IRA situations more. And that's what we're about. So, if you have an interest in precious metals, then get the information first. Spend a week or two with it. Write down all your questions and give us a call back, and make sure you understand the entire process and why precious metals may or may not be for you. So I always like to start there. We've got a couple of specials. I just loved being on this program, and we wanted to do something special. So people can get a hold of us at learinvest.com/ALT. So learinvest.com/ALT, or give us a call at 800-314-0723. And if they find us by calling the number or going to that site, we are going to throw a $500 account credit into their account immediately that they can use for shipping and insurance or whatever they need to use it for, even IRA fees, to make sure that, we're getting them the best value for their money. So I wanted to do something special for you, Alex. So we're going to throw a $500 credit into everyone's account today. And I appreciate having me on. I appreciate the education.
Absolutely. My pleasure. And thank you so much for that generous offer. Again, this has been the Alternative Investing Advantage podcast. We want to really thank Kevin for being on with us today. Appreciate the time because, as everyone knows, time is money. And that's one thing that they're not making of anymore. So you get a finite amount of it. And we appreciate you being with us today, Kevin. Thanks, everyone, for joining, and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.